Within the next 12 months, it becomes easier to follow the commercial bank verbiage and projections of 3,100 by this time next year, which I think is conservative. The money supply has increased 14-fold since 1980. And when you look at gold and silver and the way that it's traded currently in London and on the COMEX, I think these countries are using the suppression of the paper markets to their advantage, to accumulate it in copious amounts. The reason they're not complaining about the massive leverage on the LBMA, where twice global mine supply is traded every single day. In silver, it's 3.5 times annual global mine supply every day. Most of these contracts are naked short. This suppression has been done for a very long time to inspire confidence in the Western system, the bond market and the currency, and they've held down the monetary metals. And it's unquestionable when you dig deep into the naked short positions on both the LBMA and COMEX that this is the case. And the rest of these countries have been using that suppression against us by massively accumulating it and repatriating it. And, I guess I keep coming back to the fact that I truly do believe that they all have intentions of revaluing gold, ultimately, if you're going to tie gold to a system, whether it only be 40% or more, it has to be at a much higher level. And, ironically, in every single central bank balance sheet across the globe, gold is held in what is called the gold revaluation. Roosevelt did it in 1933 when he confiscated gold and then devalued the dollar by 40%, pushing the gold price from 20 to 35. And you have, like I said, the head of the Dutch National Bank who keeps saying, look, we have 20 billion in euro in gold at $35 an ounce. We should just revalue the price of gold and put it up to a level commensurate to offset our liabilities. I look to Cynthia Loomis at the Bitcoin conference in Tennessee, where she said, look, after Trump got up and said we should have a strategic account with Bitcoin, she said, yes, and I'm going to draft a bill that requests that the gold held by the Federal Reserve on behalf of the Treasury be revalued. Now, every $4,000 increase in the price of gold gives $1 trillion free and clear to the Treasury General account. And Janet wouldn't even need to get a vote of Congress, just instruct Jerome Powell to do this. Now, I know it sounds crazy, but to me, it really isn't. It's much easier path than outright default or outright hyperinflation to revalue the gold. And look, as nuts as this sounds, but it really isn't. It shouldn't be from your camp because, when you talk about Bitcoin, people have no problem seeing it at 150,000 or 300,000 or $1 million. Why could gold not be at $135,000? If it were, as insane as that sounds, our debt, our balance sheet would go from putrid to pristine just like that, and our assets would offset our liabilities. This is something that I think is possible. Now, on a microcosm scale, you see the Shanghai Metals Exchange has been pricing silver between 10 and 15% higher than it is on the West. That is what the price is if you're able to buy it in the West and deliver it to China. If the Treasury said, look, we'll pay $135,000 to any nation that wants to deliver their gold to the Treasury, it indeed is that price. Now, are they going to do it to that level? Probably not. But when you see gold going to 10,000, 15,000, 20,000 as a revaluation on behalf of the Western central banks and the BIS that reclassified it as the only other tier 1 asset, I will tell you that I do believe if it is going to be the cornerstone of this new monetary system, then it looks like it will be, at least as far as the unit, as far as the BIS, and not so sure yet here in the West, but when you see a senator from Wyoming say that, to me it's on the table, and I think it will go higher than anyone thinks possible.
Let's step back for a moment and consider the broader implications of what's unfolding here. We're witnessing something that most people only read about in economic history books, a coordinated shift that could shake the very foundations of the global financial order. When Andy Schectman talks about the significance of Russia, China, and other BRICS nations positioning themselves for a financial pivot, it's not just conjecture, it's a well-founded observation based on tangible actions. Think about it. The BRICS nations, Brazil, Russia, India, China, and South Africa, alongside newer interested members, are holding strategic meetings in the heart of Russia. Why Russia, you might ask? Because it's a direct challenge to Western hegemony. The sanctions imposed by the West, which were meant to isolate Russia economically, seem to have had the unintended consequence of galvanizing alliances that are now more unified than ever. Let's take a closer look at the backdrop of this meeting. It's not a coincidence that Russia, a country under heavy sanctions, is hosting leaders from nations that collectively account for a significant chunk of the world's population and economic output. The symbolism is clear. The BRICS nations are not deterred. They're signaling to the world that they are serious about carving out an economic path that's less dependent on the US dollar. One of the core objectives of these discussions is to find ways to diminish reliance on the US dollar for international trade. Historically, the dollar has enjoyed its status as the world's reserve currency, giving the United States unparalleled economic and geopolitical power. But now these BRICS nations are actively working to sidestep the dollar. When China wants to buy oil from Russia or Brazil wants to trade soybeans with India, they don't want to go through the dollar. They're looking to create an alternative system that eliminates the need for dollar transactions. This brings us to the concept of a gold-backed settlement system, or currency. Yes, gold, that age-old store of value that has survived the rise and fall of empires, is being reconsidered in modern finance. Imagine a system where trade settlements are backed, at least in part, by gold. It's a concept that brings stability and removes the counterparty risk associated with fiat currencies like the US dollar. And given the actions of central banks worldwide, it's not as far-fetched as some might think. Andy makes a compelling point about the silent but massive accumulation of gold by central banks. For years, we've seen countries like China, Russia, and India buying gold in record amounts. What's more interesting is how they've kept this under the radar. Central banks don't buy gold in the same way retail investors do. They do it strategically, using price suppression in the paper markets to their advantage. Here's a striking example. The London Bullion Market Association, LBMA, trades massive amounts of gold and silver daily, amounts that far exceed annual global production. Most of these trades are paper contracts, meaning they aren't backed by physical metal. It's a game of musical chairs, and when the music stops, who's left holding the bag? The answer, likely the same Western financial institutions that have been suppressing these prices for years. Why aren't China, Russia, and other nations complaining about this price manipulation? Because they're quietly using it to their benefit. They're buying gold at artificially low prices, and they're doing it in a coordinated way. It's a classic case of using your opponent's strategy against them. And the fact that central banks are repatriating their gold, bringing it back within their borders, is another clear signal that they're preparing for a significant shift. This brings us to the intriguing idea of gold revaluation. If central banks around the world are indeed planning to tie a portion of their monetary systems to gold, then the current gold price is far too low. Historically, governments have used gold revaluation to stabilize economies in times of crisis. For example, in 1933, President Franklin D. Roosevelt confiscated gold and then revalued it, effectively devaluing the dollar and strengthening the U.S. Treasury's balance sheet. Could something similar happen today? It's not as outlandish as it sounds. In fact, discussions around gold revaluation are becoming more mainstream. Some politicians, like Senator Cynthia Lummis, have even suggested that revaluing the gold held by the U.S. Treasury could help address the national debt. Every $4,000 increase in the gold price could theoretically add $1 trillion to the Treasury's balance sheet. It's a drastic measure, but in a world where traditional economic tools are losing effectiveness, drastic measures are sometimes necessary.
What's going on at the BRICS summit is kind of being held close to the vest, but I would say there are a couple of things that are sticking out to me. Everyone is talking about Project Enbridge, and certainly that is being discussed, and I'm sure we'll chat about that. But there are a couple things that I think, from a marketing standpoint, I guess you could say, it's as if they're trying to market certain information to the West. And to me, what they're trying to market to the West, they're kind of outwardly showing that they have their you-know-what together, that they're joined together in unity. And I say that we've seen For example, the discussion of Xi Jinping and Modi today are meeting on the sideline for their first bilateral meeting since 2022. That's one thing. I think they're trying to show the world that, look, we are putting our differences aside as a group, and that gives stability. Certainly, that's something encouraging from the standpoint of growing unity and a growing group of countries. Secondly, we talk about BRICS pay. BRICS pay is something that is more for the individual, whereas mBridge is more for the countries trading in commodities, as an example, and settling in what amounts to a gold-backed settlement currency. The BRICS pay would be more like, let's call it a monetary passport. To use Vince Lance's terminology, I agree with that. It's these people want to go into one of the other BRICS countries, and they're able to use their BRICS Pay app, whether it be a credit card or on their phone, that allows them to seamlessly transact in these countries without having to convert first and foremost, and all of the difficulty in doing so in countries where it might be difficult to exchange your currency very efficiently. So they're getting all their ducks in a row, all the way down to settling retail transactions with the public. And I think this is one of the deals where we have to understand that I don't expect anything to come out of this meeting groundbreaking, yet it is a trend that is certainly gaining an accelerated, coordinated group of countries that are moving in the direction, I guess you could say, critical mass, a direction that will be very difficult to challenge. As is, Paul, they already represent a much larger swath of human population, of global GDP, of military might, 3 of the 4 largest nuclear arsenals, of trade routes, of commodity production, of commodity refining. It's a situation that certainly should not be underestimated, and it will be interesting when they come out with some sort of a recap, probably on Friday, of what indeed did transpire. We do know that there's at least 30 countries there that have already expressed interest, or delegates from 13 countries that have expressed interest in joining or have fully applied, on top of the other countries that are already full members. So it's an interesting growing trend that I don't think we've even begun to see what it really amounts to. The whole premise of mBridge, first and foremost, is for countries to trade their central bank digital currencies, local trade with one another over a system that is not affected by SWIFT. And what this will do is incentivize these countries to keep their monetary homes and houses in order. The unit token itself says not more than 30% of any one currency will comprise the basket. So they've taken some of these things into consideration in terms of dominance, and the actual unit token itself is a fractal of the entire unit holding. So as things have to be adjusted primarily in the currencies, see, everything is a percentage as it relates to gold, and it's tied to gold. So as things have to be readjusted, they don't have to be readjusted on the actual tokens themselves, because the tokens represent a fractal of the entire unit. Will just automatically adjust. But as far as I've been told, no, at first, although it may be after, this will be a system that is designed primarily for the state and not for the individual.
Let's take a closer look at the BRICS summit and what it represents in this shifting global landscape. The discussions among these countries, held openly and with strategic intent, center on creating a new financial structure, one that would allow them to trade in commodities, energy, and goods without relying on the US dollar, essentially liberating them from the influence of Western financial institutions. The dollar has served as the linchpin of global trade for decades, but now these nations are challenging that reality. For these countries, the advantages of developing a system independent of the dollar are clear. For one, they can sidestep sanctions. This is crucial for countries like Russia and Iran, which have faced numerous restrictions from the West. By creating a BRICS-centric financial ecosystem, they reduce their vulnerability to such measures, making it harder for the US and its allies to use the dollar as a weapon. They're establishing economic autonomy and, in doing so, reinforcing the idea that the world's financial system doesn't have to revolve around the United States. BRICS Pay and mBridge, building the infrastructure for independence. One of the critical components emerging from these discussions is the development of platforms like BRICS Pay and mBridge. These systems are designed to facilitate transactions between BRICS countries without needing to convert currencies into dollars. Think of BRICS Pay as a monetary passport. It allows individuals to conduct transactions across BRICS nations using a single platform, bypassing the traditional currency exchange system dominated by Western institutions. Bridge, on the other hand, is geared more toward trade between central banks and large institutions. This infrastructure is essential for facilitating high-value transactions, especially in commodities like oil and natural gas. The idea is to create a system that enables countries to trade these resources using central bank digital currencies, CBDCs, or gold-backed tokens instead of the dollar. Imagine the implications. A system where China can pay for Russian oil with a token backed by gold or the Chinese yuan. That's a major departure from the dollar-dominated status quo. The inclusion of gold in these discussions is particularly significant. By tying trade settlements to a gold-backed token, these countries are creating a foundation of trust that fiat currencies can't match. The value of gold is universally recognized, and it doesn't rely on the policies of any one nation. This stability is crucial for countries looking to distance themselves from the dollar, which is subject to the economic policies of the United States and the Federal Reserve. As Andy Schectman highlighted, the idea of revaluing gold isn't just speculation. If these countries are serious about incorporating gold into their financial systems, the current price of gold is likely far too low. Imagine a scenario where gold is revalued to $10,000 or even $20,000 per ounce. This might sound extreme, but it's not without precedent. In 1933, as mentioned earlier, President Roosevelt revalued gold to stabilize the U.S. economy. More recently, some prominent central bankers and politicians have suggested that a similar move could address the mounting national debt by significantly enhancing the value of the Treasury's gold reserves. In fact, this revaluation wouldn't just benefit the BRICS countries, it could also be a boon for the United States if it chose to pursue a similar strategy. Every significant increase in the price of gold would add billions of dollars in value to the Federal Reserve's balance sheet, effectively offsetting some of the national debt. This is a radical approach, but it's one that's gaining traction among certain policymakers who see it as a way to stabilize the financial system without triggering hyperinflation. One of the most telling indicators of this potential shift is the behavior of central banks. Central banks around the world have been buying gold at an unprecedented rate. Countries like China, Russia, and India have been stockpiling gold and repatriating their gold reserves from foreign vaults. Why? Because they understand that gold offers a level of security and stability that fiat currencies cannot provide, especially in a world where the dollar's dominance is being questioned. The Bank for International Settlements, BIS, reclassified gold as a Tier 1 asset, putting it on par with cash and sovereign bonds in terms of security. This reclassification has far-reaching implications. It essentially signals to central banks that gold is a safe and desirable asset to hold. And since this reclassification, we've seen a marked increase in central bank gold purchases. It's almost as if they're preparing for a future where gold plays a more prominent role in the global financial system. And what about the price manipulation that Andy Schectman mentioned? The LBMA and COMEX, where gold and silver are traded in massive quantities, are dominated by paper contracts. These contracts are not backed by physical gold or silver, creating an artificial oversupply that keeps prices lower than they might otherwise be. But countries like China and Russia aren't complaining about this manipulation. They're taking advantage of it, buying up physical gold at suppressed prices. It's a strategy that allows them to accumulate a strategic asset quietly and affordably. It's not just gold that's in high demand. Silver, often overshadowed by its more glamorous cousin, is also becoming a critical asset. Silver is not only a precious metal, it's also an industrial metal with applications in technology, medicine, and defense. The military-industrial complex has a particular interest in silver because it's used in everything from electronics to weaponry. This demand, combined with the fact that silver is being traded in massive quantities on paper markets, suggests that silver's current price is also artificially low. Consider this. The LBMA trades about 3.5 times the annual global supply of silver every day, most of which is paper silver. If there were ever a rush to take physical delivery, the price of silver would likely skyrocket. The world's supply of silver simply couldn't meet such a demand. And once again, countries like China and India are quietly accumulating physical silver, using the suppressed prices to their advantage. So what does all of this mean for the average investor? If you're watching this unfold, it might seem like something out of a financial thriller. But the reality is that these events could have a direct impact on your savings, investments, and overall financial security. The actions of the BRICS nations, the accumulation of gold by central banks, and the manipulation of silver prices all point to a shift in the global financial landscape. For those holding dollars, bonds, or other fiat assets, this shift could mean a loss of purchasing power. As the demand for dollars declines, its value will likely drop, leading to inflation. Precious metals like gold and silver, on the other hand, are poised to retain their value if not increase significantly. They are the ultimate hedge against currency devaluation, and they offer a level of security that fiat currencies simply cannot match. Andy Schectman has often said that in a true bull market for precious metals, prices go higher than anyone expects. This isn't just a prediction, it's a historical trend. In the 1970s, gold prices surged as inflation spiraled out of control. In the early 2000s, gold rose again in response to the financial instability of the Great Recession. Now, with central banks buying gold and silver in record amounts, we could be on the brink of another major bull market for precious metals. If you're an investor, it's worth considering what role precious metals could play in your portfolio. Gold and silver aren't just commodities, they're hedges against economic uncertainty and tools for preserving wealth. As central banks continue to accumulate these assets, the supply available to the average investor will likely decrease, potentially driving prices even higher. Imagine a scenario where gold reaches $5,000, $10,000, or even higher per ounce. For those who hold gold, this would represent a substantial increase in wealth. And for those who don't, it could mean watching from the sidelines as their purchasing power erodes. Andy Schectman's message is clear. The time to act is now. Precious metals are not just for central banks. They're for anyone looking to protect their financial future. As the BRICS nations move toward a new financial order and central banks continue to accumulate gold and silver, the writing is on the wall. Precious metals are becoming the ultimate store of value in a world of fiat uncertainty. So what's the takeaway? Don't wait for the headlines to catch up. By the time the mainstream media reports on these developments, the opportunity may have passed. Take a hard look at your portfolio, consider the role of precious metals, and make a plan to secure your financial future. The world is changing, and those who prepare will be the ones who thrive.